Hey everyone, my name is Brendan McKay. I'm the broker owner of McKay Mortgage Company. We're a local mortgage brokerage in the DC metro area. And recently we've been working with a ton of clients to help them refinance with the historically low interest rates that are going on right now. So a lot of people ask me why interest rates are so low right now with everything going on with COVID, what's the relation and this and that. And the very quick explanation, the 2-second macro global economic explanation for why rates are low is that whenever there's instability in the market, it's usually good for interest rates. And what started happening at the end of February of 2020, when the first COVID case left China, that's when you saw stock markets around the world start reacting to it, and negatively. People were not sure how that was going to impact business. And when that happens, investors start moving their money out of the stock market and they start putting it in safer assets, specifically like bonds. And when the values of bonds go up, you will see interest rates decline. That is not always a one-to-one relation, but more often than not, you see that happen. So when the stock market does badly, bonds do well and interest rates drop. More recently, over the last couple of weeks, the stock market has actually done very, very well, but we're in a really weird time where a lot of that might have more to do with people not sure where to put their money than anything else. But despite that, you have seen interest rates remain low. And the main reason for that is the federal government's interest in interest rates remaining low. And specifically the action of the Fed, although not for the reason most people think. People say, oh, the Fed dropped rates to zero, rates must have gone down. That in and of itself does not have that large of an impact on mortgage rates. It will on home equity lines of credits and credit cards and car loans and business loans and short-term loans. They do that to kind of try to stir up people borrowing money and businesses borrowing money and making things more products and people to spend money and churn the economy. The Fed, the way they controlled interest rates is by creating a false market for all these mortgage-backed securities. So when someone closes on a loan and on their mortgage is bundled up with a bunch of other mortgages and turned into a commodity called a mortgage-backed security. And a lot of those end up at Fannie Mae and Freddie Mac and they're securitized, but they're sold on the secondary market as a commodity. Usually the free market dictates a lot of that and they're bought on Wall Street and this and that like you'd expect. But there's less of a market for that right now because you have a situation where a lot of people are out of work and may not be making their mortgage payments. So the value of mortgages as a commodity might not be what it should be otherwise. So the Fed steps in and just says, we are essentially earmarking an unlimited amount of funds to buying mortgage-backed securities. So they've created this market which has put the value there, which is why interest rates are continuing to be low because there's a market for low interest rate mortgages. And also, if you would like me to run a scenario specifically for you and your specific situations, just email me a copy of your mortgage statement. I'd be more than happy to do so. Thanks for taking the time.